Hello and welcome. Before we begin, don't forget to click like and subscribe and share this episode with a friend. In today's episode, we're going to discuss one of the most basic accounting methods, the cash receipts and disbursements method, or as most people call it, the cash method. As tax law goes, this is one of the more straightforward sets of rules, but even it has a few wrinkles you need to be aware of. Let's start with the basics. You may remember from our earlier discussion of the accrual method about the need to determine when all of the facts have occurred to fix the right or the obligation. The amount can be determined with reasonable accuracy, and in the case of deductions, when the economic performance rules have been satisfied. Those rules can create some real head scratchers. Well, with the cash method, none of that matters. Subject to a couple of exceptions we'll discuss in a few minutes, the cash method means just what it says. You have income when you get paid, and you get a deduction when you make a payment. The 11th Circuit's description of the cash method is a classic. The cash method, simple, plodding, elemental, stands firmly in the physical realm. It responds only through the physical senses, recognizing only the tangible flow of currency. Money is income when this raw beast actually feels the coins in its primal paw. Expenditures are made only when the beast can see that it has given the coins away. Sounds pretty simple, and for the most part, it is. But as with anything in the tax law, there have to be at least a few wrinkles, or else where's the fun? First, looking at this from the income side, what does it mean to be paid? Well, you've been paid if you've received either cash, property, or services. Like the 11th Circuit said, you feel the coins in your paw. A lot of the case law in this area predates the era of electronic banking, allowing you to bank anytime, anywhere at your convenience. Payroll direct deposits and online bill payments, smartphone apps that let individuals transfer funds between one another electronically, just using their phones. But because a lot of small businesses still rely upon traditional forms of payment, the old case law is still important. If someone gives you cash, a credit card, or some sort of electronic transfer, you've obviously been paid. But what if they give you a traditional check? Well, for the most part, a check is the same as cash. Under the so called mailbox rule, you make a payment on the day that you place a check in the mail, and you receive payment on the day you receive a check. It doesn't matter when the check actually clears the bank. So, for cash method taxpayers looking to maximize year end deductions while keeping the cash in the bank a few extra days, dropping a check in the mail by midnight on December 31st can help meet that goal. Just make sure you put a stamp on the envelope and preferably get proof of mailing. Oh, and on the income side, forgetting to check your own mailbox is not a way to avoid recognizing income. You have income as soon as your customer's check hits your mailroom, whether you know it or not. If the buyer promises to pay you later, normally you won't have income under the cash method until they actually pay you. But what if the buyer gives you a promissory note? Well, sometimes under the cash equivalence doctrine, the promissory note might be treated as property with a fair market value. For tax purposes, getting paid in property is no different than getting paid in cash. The only difference is you have to figure out the fair market value of the property to treat it as payment. A number of considerations come into play in deciding whether a promissory note is the equivalent of cash: the solvency of the person issuing the promissory note, whether the note is unconditional and assignable, whether it's considered negotiable, meaning It can readily be sold at a discount that isn't much more than current interest rates. And whether the parties intended for the note to constitute payment or instead just as a promise to pay in the future. So, cash method taxpayers accepting promissory notes as payment cannot automatically assume that they don't have income until they have cash in hand. Depending upon the specific facts of a particular note, the cash equivalence doctrine might say otherwise. A key exception to the simple rule of gold crossing your paw is the doctrine of constructive receipt. You can't just turn your back on money that you've got a current right to collect without restriction. If someone owes you payment and they're holding it out for you to collect, you can't just say, yeah, hang on to it and pay me next week. Well, you can, but you're still going to be taxed as if you collected the money when it was available to you without restriction. For example, on December 31st of year one, a farmer drives a load of grain to a local grain elevator to be sold for $1,000. The buyer is ready to pay the $1,000 contract price right then. Here's your money. But the farmer's had a good year and he wants to defer having to pay tax on that $1,000 until next year when he's expecting things to be a little slower. So he tells the buyer, just pay him next week after January 1st in year two. The buyer's happy to hold on to the cash for a few more days, so everybody's happy. Well, everybody that is, except the IRS. From their perspective, the farmer has $1,000 of income in year one, even if he doesn't receive the actual cash until year two. Under the constructive receipt doctrine, the farmer has turned his back on income which he was legally entitled to receive without restriction. And so, under the cash method of accounting, he constructively received payment on December 31st and has to pay tax on it that year. So, what could the farmer have done in this fact pattern? Well, the constructive receipt doctrine only applies if you already have a legal right to payment at the time you turn your back on the money. So, all the farmer needed to do was to agree with the buyer before selling the grain and becoming entitled to payment that even though the grain was being physically delivered on December 31st, the farmer would not be entitled to payment until January 1st. So long as the buyer and the seller agree to those terms before the deal closes, they're perfectly entitled to write their contract any way they want to. And under the cash method, our farmer would only have to pay tax on his $1,000 sales proceeds on the following year's tax return, since he will neither actually nor constructively receive it until then. The cash method works pretty much the same way in deducting expenses, again with a major exception. Under the general rule, a cash method taxpayer can deduct an expense in the tax year in which actual payment occurs. You feel the coins leaving your primal paw. You pay the power bill. You pay your employees. You pay your rent. You deduct those expenses in the year in which you make actual payment in either cash, property, or services. Unlike the income rules we just talked about, there's no such thing as constructive payment to let you deduct the expenses before the coins leave your paw. But what if you're prepaying for something? You write a check this year for an insurance policy that will cover 3 business years. Or you prepay for the office supplies you need next year. And you write a check on December 31st to try to create a big deduction on this year's return. When you prepay a future business expense at the end of the tax year, you create an intangible asset that will benefit your business for more than one tax year. Recall our earlier discussions about the requirement to match expenses with related items of income and our discussion of why you have to spread the costs of business assets over more than one tax year if those costs relate to income you expect to earn in future tax years. Well, that rule applies whether the business asset is tangible, like machinery, or intangible, like a prepayment for services your business will need next year. However, you can still deduct your prepaid business expenses if they satisfy the so called 12-month rule. Under this rule, the prepayment is fully deductible in the year of payment so long as the benefits don't extend beyond the earlier of either 12 months after the right or the benefit begins or the end of the tax year following the year in which you make the prepayment. The cash method provides tremendous benefits for taxpayers eligible to use it. Small taxpayers like it because it's simple and inexpensive to apply. It's a fairly intuitive accounting method, and since it's used by nearly all individuals, small business owners are already familiar with it. The cash method also provides a lot of flexibility in tax planning because, subject to the constructive receipt rules for income and the 12-month rule for expenses, you have a lot of flexibility in accelerating deductions and deferring income if you're careful with your tax planning. So, then why doesn't everyone use it? Because it's too simple to deal with the complicated accounting required by most larger businesses to clearly reflect their income, particularly for those in certain types of industries, such as the production and the sale of merchandise. The tax code also keeps a close watch on who's using it because its simplicity can be abused by those up to no good. Certain types of businesses specifically are allowed to use the cash method, though, including any small business other than a tax shelter having gross receipts under a specific threshold, right now around $25 million dollars annually. Most farming businesses, except those run by large corporations and partnerships, and personal service corporations. A personal service corporation is a business performing certain types of services, such as health, law, architecture, and accounting, and that's owned by current and retired employees. Even some larger businesses might be able to use the cash method, depending upon how they're structured and the nature of their business. So, the cash receipts and disbursements method is an attractive option for smaller businesses, farmers, certain service providers, and even for some larger businesses structured certain ways. If your business is not currently using it and you think you might be able to, give it a look. But remember, you have to get the IRS's approval to change to the cash method from your current method. Well, that's it for this episode. Keep checking back for more and don't forget to like and subscribe.